Oliver, today we're going to ask, should we be buying Barclays? Let's leave all the politics aside, all the screaming aside, all the populism aside, all the bank bashing aside. Let's pretend we're an investor. The shares are at 170p or whatever they are, almost at all-time lows. It's darkest before the dawn. Is it time to buy them?
Well, they're certainly cheap, there's no doubt about that. They're trading on a valuation of about 0.4 times book value. That's very cheap. European rivals such as BNP Paribas and Deutsche Bank are on 0.5. American banks like JP Morgan are higher than that, on about 0.8. So without a doubt, the shares are very cheap. There are very good reasons for that, though.
Well, I mean, it's cheap, they've got a gap to fill. How much of that sort of nastiness in terms of regulatory outlay, perhaps there's mitigation, problems in Europe, you know, we know all the bad things that are out there. I mean, perhaps that's in the share price already there.
I think a lot of it is already in the share price. I think the key for Barclays, if it's going to close the valuation gap with its rivals, is really to improve its returns. And in the case of banks, it's return on equity that everybody looks at. Barclays' return on equity last year was lower than that of its European and American rivals. And if it's going to close the gap, it really needs to do something to improve that. There were some encouraging signs in the first quarter, particularly in the UK retail bank, where returns improved because of lower provisions. But in the long term, it's going to be the investment bank that's going to have to drive that. And the question there is whether the economy will pick up sufficiently to allow the investment bank to really motor on.
And if you look at like a DuPont model of ROE and the components that may improve it, I mean, you've got to think that they're not going to get any leverage gains over the next few years. That's out. No. What about cost cutting, for example?
There's probably some scope for cost cutting in the investment bank. Certainly when a new chief executive comes in, he'll want to demonstrate to the city that he's getting to grips with the investment bank, so there'll be a little bit of cost cutting to come there. In terms of revenue, there might be opportunities long term, particularly in Barclays' debt capital markets businesses, which is particular Barclays' strength. So there's opportunities there, but the leverage side of it, as you say, is a no-go at the moment.
And of course the volumes were okay in the first quarter, and really I guess you need an improving economy, Europe to turn around, US for the Lehman's business. It's probably a volume game at the end of the day, right?
Yeah, that's right. If things pick up and it can do a little bit of internal work to nudge its returns up, then over the long term the outlook for the shares is probably quite good. In a few years' time, investors might look at 0.4 times book value and say, wow, that was a steal, but it might be rough in the meantime.
So probably a buying opportunity if you're brave and you're looking in the long run, but chances are it's going to be volatile before then, so probably suit different types of investors. So thanks very much, Oliver.